So the Fed has told us in the statement they think the Fed funds rate is the primary mechanism here. That's how they're going to conduct monetary policy. They're trying to kind of push people off of obsessing over the balance sheet. What is the impact of all of this going to be, of quantitative tightening, when it does happen, and why are they emphasizing the policy rate so much?
Yeah, so one of the things that I think that the market's taking away from this is that there was a fear factor being built up that the Fed would be overreacting to the current inflation environment right now. And we're not seeing that. The statement was very, I guess, somewhat tame. But look, I mean, the balance sheet is the absolute critical policy measure for this year. We've priced in 4 rate hikes this year. That's probably what we're going to get. That's yesterday's news. The big issue here is how the Fed uses their balance sheet, and also what level of inflation does the Fed feel comfortable with? Are they going to stick with their 2.6, 2.7% core PCE target by the end of the year, or would they claim victory at 3%? Is there a level that the Fed overreacts to with inflation? If it does, then the fear is that the Fed starts to go much, much more aggressively. So the balance sheet is really the area that I think that the Fed can actually start to fine tune at least the back end of the curve, because as Tyler was commenting on, that's the only real way that they can keep back end rates higher. There's still a lot of money in the system. There's still a lot of QE. If all they do is push front end rates up and keep back end yields really, really low, that sends the wrong signal to the market by having a very flat or even possibly inverted yield curve by the end of all this, but say by 2023 or 2024. So there needs to be some, complementary moves here. Mm-hmm. Maybe they do less rate hikes and they do more with the balance sheet. But this is a discussion for the second half of the year. But we're going to start having this discussion early right now, because it's going to matter a lot for asset prices.
I think it was Rick who mentioned the possibility of an inverted yield curve just a few minutes ago. Mona, let me turn to you and get you to react to what David said there about interest rates being too low for too long. 40 years was I think the number he said. That it feels a little bit like what David is saying is that low interest rates are a kind of financial crack. Crack cocaine, that is. And now we are being titrated off of that. Can the economy deal with that? Can the markets deal with that? And how slow or how fast will the Fed need to go as it calibrates this titration away from financial crack?
Yeah, absolutely. Look, we're already getting signals from the market that as the Fed raises rates, those more speculative assets, the ones that were highest valued from a valuation perspective, they are getting hit hardest and hit first. And we expect that phenomena to continue as this Fed rate hiking cycle progresses. Keep in mind, historically, when the Fed tightens rates, we do get valuation compression across markets, but it is the highest valuation parts of the market that do get hit hardest. So we certainly expect that phenomena to continue this year. More broadly, though, when we step back and look at where we are in this economic cycle, we still, very much feel that we are mid-cycle in this economic expansion post-pandemic. Keep in mind, we have a pretty healthy consumer. We have earnings growth looking 7 to 9% range. We have economic growth still above trend, 4%. And so can this economy handle 4 Fed rate hikes this year? We certainly think that will not derail the underlying expansion. Now, as we head to 2023, perhaps 2024, economic growth will return back in line with trend. And that's when we really have to start thinking about where we want to be in terms of inflation, interest rates, and what level of, the yield curve and yields can this economy handle. But certainly for 2022, still very much mid-cycle, still very much early days in this Fed rate hiking cycle. And from a market perspective, that also portends pretty well. Perhaps we will get a more value cyclical bent early on. But we think down the road, when growth slows, growth sectors will return back into favor as well. So certainly we favor holding a balanced portfolio here, using volatility as opportunities, because we are not near the end of this cycle yet.